Welcome to the Retirement Planning Podcast with certified financial planners Richard W. Paul and Stephen Paul. Listen to a highlight from our recent radio show as we discuss the worlds of finance and retirement. Steve, Rich, welcome guys. How are you?
Doing terrific today. No complaints here. Moving right along. It's been a fun day so far.
Absolutely. Enjoying the spring weather. It's finally here.
Yeah, for how long, right? I'm just wondering what's going on with the weather because it seems like every time we turn around it's something different. I don't know. But I got a question for you. I did not fare so well with my March Madness bracket. Either one of you guys do, and how'd you do so far?
Oh, it's a disaster. I think everyone's bracket's a disaster.
I think so, yeah. Well, as soon as North Carolina and Virginia lost, I was all messed up.
Oh, yeah. State let me down.
Yep, and there's another one, yep. So all the ones, I think I should have been, what I should have done? I should have taken more risks and not gone with the conventional wisdom in a few places. So I think maybe I'll have to do that next time. And actually, speaking of risk, let's kind of segue right into our topic today, types of risk in the financial world, not in the NCAA bracket world, but in the financial world, which is where you guys shine. So let's talk a little bit about the different types that are out there. There's more than just a couple. I think people might be surprised at some of the ones that we'll talk about, as well as you might be thinking, okay, yeah, I know about that one, but are you really using that and using that information in your portfolio, making sure that you're being aware of these things? So let's start with the big one, market risk. I think this is what most people think of when they hear the word risk, and while it's not the only one, it's definitely one we got to address.
No question there. And simply put, carrying too much market risk on money needed for retirement could in fact derail your retirement, and that's the big conundrum here. It could put you potentially in a spend down situation, which then ultimately puts you in a situation of maybe running your account out of money.
Yeah, this is the big risk. Market risk is the big risk. And a lot of people have kind of forgotten about it. The consumer confidence is just sky high right now, but this little bit of a pullback or correction that we had at the beginning of this year reminds you that there is significant risk in the market. It doesn't just go straight up, it can go down. So if you took a big hit in the beginning of this year, it gives you a pretty good idea of how much market risk is in your portfolio.
Yeah, in fact, even the experts, it's funny because I'm always reading the commentary, and this was an interview, Can the Bull Market Keep Going? And so they're interviewing Liz Saunders, Chief Investment Strategist for Charles Schwab. And so she says, they're asking the question about can it keep going? And she says, well, I've been bullish for the whole bull market, and I remain so, but I think we're entering into the latter part of a cycle, both in terms of the economy and also the market. So I think we have to start being mindful of some of the risk. And then you got Rob Arnott, Chairman and Chief Executive of the asset management firm Research Affiliates, and he also manages the PIMCO All Asset Fund. And he goes on to say, I look at today's Shiller PE and don't draw a conclusion that the end of the bull is imminent. But then here's the qualifier. Okay, you ready? I draw a conclusion, though, that there are pretty high odds for a lost decade for equities going forward. I'm like, whoa, okay.
Okay.
Another 2009 on the way here. I'm like, so it's amazing the diverse answers that you get. And there's 3 or 4 other commentators in here, and they're all over the place.
Yeah, it's definitely scary hearing something like that. That's why we preach at this firm, protect what you've worked so hard for, start to de-risk the portfolio, geared toward income, the closer and closer you get toward retirement.
Yeah, that's our whole mantra really is making sure you're positioned properly. And Mark, we've talked about this quite a bit on the show here, is that we get people coming in, we sit down with them, and they're not allocated properly, and because we don't know what's going to happen. We hate diversification when the market's really skyrocketing, because we say, why don't we have it all there? And that's the conversation.
Right.
Well, that's the reason, because we don't know when we're entering into a market that could really hurt you over the next 5 or 10 years, and so you got to be prepared for anything that can come at you.
Yeah, you can't miss with the S&P 500, right?
No.
It only goes up.
It only goes up, right? Yeah.
Well, it's certainly a good conversation here we're having today, folks, about types of risk. Of course, we were just discussing market risk, which is kind of on the forefront when people think of the word risk. And this is the Rich Paul Show, 248-305-9911, 248-305-9911, if you'd like to talk with Rich and Steve and get on the calendar. Interest rate risk, guys, that's another one. I think most people assume that if they don't borrow money very often, then they won't really have to be affected by interest rates going up. But I think a lot of us don't understand the impact that rising interest rates can have on, like bonds, for example, in the portfolio.
Just simply put, interest rates go up, bond values go down.
Yep.
You have a 3% interest rates go up to 4%. Let's keep it simple. Nobody's going to want your 3% bond anymore. You're going to have to sell it for a discount. What a lot of people are doing, a lot of investors are doing right now with the interest rate environment that we're in, is they're moving more into high yield bonds. Everyone kind of hears that bond word and goes, those are safe, bonds are safe. High yields can be very risky. They're going to return more. They're going to have a nicer rate of return. You're going to make a little bit more money off of them, especially in thriving economies like we're in right now. But you need to be very careful. You look back to 2008, over a 25% loss in high yields. So the bond market is very tricky right now. One of the things that we want to keep an eye on is interest rate risk.
Yeah, no question. After 30 years of declining interest rates, the good old days are over. This is not only where interest rates were going down, where you actually earned a gain on your bonds on a pretty systematic basis. Now, last year, what did we have? 3 rate increases, and this year we're looking at maybe 3, possibly even 4 rate increases. So that means now bonds, as you were saying, are
just
going
saw
to
another rate increase this week.
Yeah. So that means we're looking at a decrease in bond value. So there's going to be a downward pressure on bonds going forward. So when you start looking at those maturities, those durations on those bonds, the longer they are, the more impactful these interest rates increases are going to be. So I'll tell you, it's a very, very good time to reassess your bond holdings given the interest rate environment that we're in. And so if you're readdressing your bond portfolio, we strongly suggest you get a bond evaluation done and have us come in, take a look at that for you, and see if you could be situated in a little bit better position.
Well, this has been the Retirement Planning Podcast with certified financial planners Richard W. Paul and Steve Paul of R.W. Paul and Associates. Make sure that you reach out to them at 248-305-9911. That's 248-305-9911. This has been the Retirement Planning Podcast.
All matters discussed during this show are for informational purposes only and shall in no way be construed as a solicitation to sell securities or investment advisory services to residents of any state other than Michigan. Topics should be discussed with your individual advisor prior to implementation. Investment advisory services offered through Richard W. Paul and Associates, LLC, a registered investment advisor. Insurance services offered through Midwest Financial Consultants, Inc.